All right, hello everyone, and thank you all for joining us during the Lytham Partners Winter 2021 Investor Conference and what we are calling our 2022 Vision event. My name is Robert Blum, Managing Partner of Lytham Partners, and during this fireside chat, we welcome LiqTech, ticker symbol of LIQT on the NASDAQ, and their CEO, Mr. Sune Mathiesen. We will dive into questions in just a moment, but I always want to remind everyone, if you'd like to arrange a meeting with Sune, please send me an email. My email is blum, B-L-U-M, @lythampartners.com. With that said, let's begin. Sune, let's just sort of very broadly start at the top for those that might be newer to the company. Give a little bit of an overview on the company and its products.
Sure thing, Robert. So LiqTech was actually founded more than 20 years ago based on the idea to manufacture diesel particulate filters, and that is something we still do. First, we applied the diesel particulate filters to large vehicles, trucks and buses. Now we more apply them into off-road machinery and also into the marine industry, which I think we'll talk hopefully about later. And also we developed about 15 years ago, we started the development of a ceramic water filtration membrane, which is where we see the growth in our company. About 2014, we completed that development. And since then, we've been looking for a home for our technology. And we found that now, within several industries, including the marine industry, oil and gas, food and beverage, and many other applications.
All right, so let's start right there with the marine industry, as you mentioned, and maybe more specifically the marine scrubber market. It had ramped up pretty rapidly pre-COVID. I think you did revenues of $23.5 million in 2019. And then in 2021, you're expecting just $4 million in marine scrubber revenues, but looking to ramp back up in 2022. Talk about some of the drivers there that give you confidence that this rebound in 2022 is to occur.
It's correct that in 2019, we saw a steep ramp in our marine scrubber business. It was you could say it was the first application where we succeeded in commercializing our membrane technology. The reason for the steep ramp was a new mandate by the IMO 2020, which is a new lower cap on sulfur emissions from international shipping. It leaves the ship owners with two alternatives. One is to switch to low sulfur fuel and be compliant with the new regulation that way. And the other solution is to install a marine scrubber and continue to use bunker fuel, but to clean the emissions by using that marine scrubber. In 2019, we saw big interest for marine scrubbers, hence the steep ramp in revenues for us. What happened with COVID is that oil prices came down dramatically, and so did the price for low sulfur fuels. Transportation came to a stop throughout COVID. There was no air traffic, there was less shipping, and people simply didn't take their cars and go to work. So it also means a big surplus of refining capacity in the world. And that's the reason for the big drop in the low sulfur prices that occurred during COVID. It also meant that the business case for marine scrubbers was simply not there anymore. We need a price spread between $75 and $80 between low sulfur and bunker fuel for marine scrubbers to be an attractive business case. And throughout COVID, it actually came to a negative and then started climbing again towards the end of 2020. Since February 2021, we have now seen a stabilized price spread between the two of more than $100 per metric ton. And it also means that the business case for marine scrubbers is now quite strong again, with return on investments between 18 to 24 months. We have now recently seen that the price spread has increased quite dramatically again. I believe as we speak, it's around $135 per metric ton. And that means that the business case for scrubbers is again strong. What we saw in February this year is that the big ship owners, they came back and they started looking at the scrubber installation plans again. And that has led to increased activity in the market. It has led to more inquiries and more orders. So when we now predict a nice uptick in our marine scrubber business again in 2022, it is really based on the activity in the market, both in terms of inquiries, but also in terms of the order book we are building for 2022. So it's really based on real orders that we now see in our backlog.
You talked about the IMO regulations, and recently there was some discussion, I think in mid-November at the MEPC 77 meeting, talking about potential harmonization of the scrubber discharge regulations. Any updates on what came out of that meeting?
Yes, so it was discussed on the meeting, and the decision was to put this task on one of the subcommittees in the IMO, the PPR committee. And they have now been tasked with harmonizing scrubber discharge regulations, which they will do in 2022. The expectation now is that the PPR commission will be able to recommend whatever they think is the right solution to the next MEPC meeting, which is in June of 2022. So basically, the outcome from the IMO meeting was what we expected, namely a continued focus on the harmonization of scrubber discharge regulations. As many of our investors probably know, there are currently 140 ports around the world that have banned open loop scrubber discharge. And recently Turkey also joined the countries that have done so. So there is a big push, and there continues to be a big push to ban the discharge from open loop scrubbers. And I think this has been reinforced by the recent discussions on the IMO meeting in November. And we now expect to have, let's say, a clear recommendation from the PPR committee on the next meeting in June of 2022.
Okay. Let's transition to oil and gas here, which you mentioned is another sort of key end market for your filtration solutions. You recently announced your first orders within the Middle East, or with your Middle East joint venture partner there. You've also announced additional orders in other oil and gas applications, such as deep sea drilling, for instance. Talk about what the opportunities are within oil and gas. And again, this is our 2020 vision. Talk about what your outlook is for 2022 within the oil and gas segment.
Yeah, as many probably know, we have been laser focused on the opportunities that we see in the Middle East. And the reason why we are laser focused in the Middle East is basically increasingly water scarcity. To explain why we are focused, we have to explain also what it is they do today. Today, they take seawater, they desalinate it, they truck it on site, they inject it into the ground to increase pressure, which drives the oil to the surface, and the water comes back dirty. For every barrel of oil that is produced, you get about 3 to 4 barrels of dirty water. So these are huge amounts of water that are wasted every day. Today, they truck the water away from the production site. They then store it in disposal wells. And all of this is obviously bad for a number of reasons. One is that you use water you don't have in the first place. You desalinate it at a very, very high cost. You have all the environmental impact from the trucking and, of course, the cost associated with that. And then you store it in disposal well, which is also posing an environmental risk. What we have proven through several pilot projects in the region is that we have a technology that enables them to take the water directly that comes out of the ground and clean that up and then re-inject it and use the same water over and over again. So that eliminates all the trucking, it eliminates the desalination, and also it saves, let's say, the environmental risk from storing that dirty water. We now see that legislation is tightening in the Middle East, and that's the reason we have now received that first order. We are expecting follow-up orders very soon. And as we go into 2022, we have built a terrific pipeline of projects in oil and gas, and we think that we'll see some much bigger orders in 2022 than we've done in 2021. But the first order is always hard to get. We have been waiting a long time for that first order we announced a few months back, and we now see that the next orders seem like it's an easier path to actually get those orders. So we're very optimistic about the opportunities in oil and gas, and we are now starting to see orders outside of the Middle East as well. So we have recently announced orders from ONGC in India, and we're working with several other oil companies globally on several projects.
On the Middle East joint venture, the business model is a little bit different there as opposed to what you're doing, I think, in almost all of your other applications and end markets. Talk a little bit about what the business model is with the joint venture, and then also what sort of the margin and revenue opportunity and maybe level of predictability it can bring to LiqTech going forward.
So what we do in the Middle East is we work with our joint venture partner to offer the end users a build, own, and operate model. So it means we are selling our equipment to the joint venture company where we are a minority owner. The joint venture company is financed by our joint venture partner. So it also means we are not putting up the financing to buy the initial equipment. We are selling the equipment on normal terms, which means normal margins, normal payment terms, normal everything. And it also means that we are making quite healthy margins on that initial equipment sales into the joint venture. Then the joint venture will enter into lease agreements with the end users. They are multi-year agreements, and it means that the revenue flows into the joint venture on a regular basis. There should be a profit generated from that operation as well. As it looks right now, it's actually quite a healthy profit. And when the year comes to an end, the joint venture will then distribute that potential profit to our joint venture partner and to LiqTech. And that's kind of the second, let's say, profit stream from that operation. It also means that revenues generated is from the original equipment sales, and also there's a profit generated on that initial equipment sales. In terms of the revenue that flows into the joint venture, we are a minority owner, and it also means that we're not able to recognize any revenues from that. But we are able to recognize the profit, and that comes below the line on top of the, let's say, profit we already realized from the equipment sales. All the equipment is paid back during that initial rental period. But we are, of course, expecting that after the initial period of time, the oil companies would be interested in renewing those rentals. And if they do that, it's obvious that the profits made from the second period will obviously be higher than the first period because the equipment is already paid for. So in time, it also means a very nice profit that can flow in from, let's say, that portfolio of projects that we are building over time.
And some of the customers that you're working with in the Middle East, I know you mentioned Baker Hughes. You've also mentioned Chevron for the, I believe that was the deep sea applications. These are the large sort of multinational type companies that you're working with, correct?
That is correct. So the first order came from Baker Hughes in the Middle East. We're working with Chevron for deep sea drilling applications. As I mentioned before, we work with ONGC in India. And we're working with many others. We are not limited to working with Baker Hughes in the Middle East. We are working with several other players, and we're also working with some of the oil companies directly. So we are getting, I would say, a lot of traction, and we're finding out that the oil industry is actually a very small industry. And it also means that when you do a project with one company, they talk with all the competitors in the market. And actually, the Chevron business came from a recommendation from Shell. And it just proves that this is a very, very small industry where it's big potential. But when it comes to the number of people involved, it's actually a quite small industry. And we're working on projects not only with the partners we already talked about. We're working with Shell, we're working with Total, and many, many other names in the industry. So I'd say we're really getting traction both in the Middle East and outside of the Middle East.
Okay. Let's transition to the black carbon market in China focused marine emission reduction. It's as you've described, a massive market, and again, very similar to these others. It's being driven by some changing regulations. Again, maybe for those that are newer to the company, let's first talk about the market in general, the sizes, and some of those regulations that are driving it.
Yes, so it's correct. We're looking at many applications in marine, and marine scrubbers was the first application we identified in marine where we thought there was a good potential. We were kind of first movers in that closed loop marine scrubber application. And it also meant that we've been able to build a very nice market share of 50% in the closed loop market. We have since then started looking at where are other potentials on marine, because what we have seen on-road transportation, for example, is tightening legislation throughout the years. The emissions from a diesel engine today is quite different from what it was 25 years ago, and that's because there's been a continuous, let's say, implementation of new mandates and new lower caps on emissions. And the same thing is happening in marine. And the next opportunity we have identified is black carbon reduction from marine vessels. Black carbon reduction was actually also discussed on the latest IMO meeting in November. They were discussing implementing a black carbon reduction mandate in the Arctic region, and it just proves that there is a global focus on black carbon reduction as well. But the opportunity we're working on right now is in China. It's a new lower cap on black carbon emissions from inland vessels. And what is unique about China is that they have a tremendous amount of inland vessels. They have about 180,000 transportation inland vessels. And that's, of course, because the infrastructure in China is not similar to what it is in Europe and the US, where we have a lot of highways, we have a lot of trucking. They have not traditionally had that in China, which is why they've used the inland waterways instead. Now the government in China is implementing a new lower cap on black carbon emissions, and that has opened up a $26 billion opportunity to retrofit these 180,000 inland vessels with black carbon reduction equipment. We have been in China for quite some time. We've been working with the largest player in the industry in China, which is CSSC, the largest shipyard in the world. We have a 4-year relationship on marine scrubbers, and we are now approaching this black carbon reduction market together with this customer as well. It's a huge opportunity. We are building a new factory in China to handle this opportunity. The factory in China will have a yearly capacity of $225 million in revenue. So obviously a huge factory for a company like LiqTech, but a relatively small factory compared to that $26 billion potential that we think there is. And this is, again, only the start. Since we announced our plans to build this factory in China, we have been approached by shipyards in Europe and in North America that are now looking at black carbon reduction equipment for inland vessels, both in Europe and North America. So we will see tightening legislation globally. The start is in China. We are ready for it. Again, we will be a first mover, and we think we are well positioned to be an important supplier in this industry. There are many ways to achieve the target of reducing black carbon, by the way. So we will not be alone. There are many different technologies that can be used. But I think we have a number of advantages over that technology. One is that we are using a 20-year-old technology, something that we've been manufacturing for 20 years, something we know that works. We are now applying it in marine instead of on road. Number two, we are working with CSSC, the biggest player in the industry. I think that kind of validates our technology as well, and ensures that we have an access to the market. And then lastly, we actually have one of the technologies that is most affordable. Even though it's well proven, it's also quite affordable compared to the other alternatives that you can use to reduce black carbon, and it's also one of the most efficient ones. So we are looking forward to this adventure. We have already acquired the factory in China. We're in the process of installing the infrastructure, so it means electricity, water, compressed air, whatever we're going to use. The equipment starts to come in early next year, and we are scheduled to be operational in the second half of 2022.
So let's talk about some numbers here. During the third quarter conference call, you made reference to China being somewhere around $2 to $5 million in 2022 in terms of revenue, but you put a quote unquote significant revenue ramp expected in 23 and beyond, which follows the completion of the manufacturing facility that you just mentioned. You know, what ultimately gives you the confidence that that business is going to be there in 2023 to warrant these types of investments that you're making?
We know the market is there. We know that these regulations are happening. We see from all the inquiries we now get from shipyards in Europe and North America that it's not only happening in China, it's happening globally. So we think the market is definitely there. The reason why we're modeling $2 to $5 million in revenues from China next year, which seems like a very low number, is that we are not going to be operational until the second half of next year. So we are only modeling one, maximum two months of revenue from a Chinese factory in 2022. As we head into 2023, the factory will be ready. The market is there. And the hope is that we'll sign some big framework agreements in the next 3 to 6 months that ensures that the capacity will be utilized already from 1st of January 2023. And we think that is very likely. We are already in those negotiations. It's still, more than 12 months away. So, it's the beginning of those negotiations. But based on the feedback from the customers, we think it is likely that we'll firm up those agreements in the next 3 to 6 months. So a lot of confidence. The market is there. We have the technology, and I think I'm I'm very encouraged that we now see a demand not only from China, but also from Europe and North America. That proves to me that this is really happening, and that we have been successful in being first movers in this industry. We now see that some of our potential competitors are talking about doing the same thing, but it also means that we have quite a good head start. And we will be the only ones that are ready for the beginning of this mandate, which is in the end of 2022.
Okay. We've talked about marine scrubbers, we've talked about sort of black carbon reduction in marine, and we've talked about oil and gas. But in the guidance that you gave back in November for your 2022 guidance, which was $50 to $80 million of revenues, that was up compared to, I think, about 18 to 20 million estimate for what you believe 2021 is going to be. But of that sort of 50 to 80, 23 to 36, I think is the number here, million of that revenue was sort of from other products. Some of those including OEM membranes making up a big part of that. Help people understand what that market entails and some of the sort of applications and markets you're looking to sell into there are.
Already this year in 2021, we have seen a nice uptick in our membrane business. When we started developing our ceramic membranes in 2006, the idea was to sell the membranes to water treatment companies who would then apply them into their systems. When the product was ready in 2014, we started taking these membranes to these players. And unfortunately, there was not a big appetite to buy the membranes we developed because it was new and unproven technology. Since then, we have on our own converted our company into a water treatment company, and we have proven our technology in several industries, including oil and gas, as we already discussed, marine scrubbers, food and beverage, pharmaceutical industry, and many others. And what we now see is that the market is ready for ceramic membranes. You could probably argue that we developed the technology for a market that was not there, but we now see that the market is there, and we see a demand for ceramic membranes. And it also means that we are getting more and more inquiries, we're getting more and more orders, and already in 2021 we have seen a nice revenue increase in membrane sales. We have also launched some new products that now means we can compete in several industries, not just only heavy industry, where we have traditionally been, but also in food and beverage and pharmaceutical industries where the ceramic market really is. We are already entering into agreements with customers now for membrane supplies in 2022. And that is what provides us the confidence that we will see that revenue increase in these applications or in the sales of membranes in next year. So it's really based on, again, both on inquiries, market development, but also based in orders that we have already booked and that is now in our backlog.
Okay. In the couple of minutes we have left here, let's talk about gross margins. Your guidance or estimate for 2022 was sort of combined gross margins all in of 30 to 35%. You specifically broke out contribution margins by each one of those segments. Oil and gas was as high as 60 to 65%. Marine scrubber 40 to 45%. The black carbon was sort of in the 30 to 35%. The OEM membranes and such have, I know, some higher margins to it as well. When you look at 2022 and then maybe looking a little bit further beyond that, what is an ideal all-in combined gross margin for this business?
Yeah, we said blended gross margins 30 to 35 for 2022, which is kind of a starting point. We spoke earlier about blended gross margins of more than 40%, which is still the goal to achieve. So it also means when we get to the end of 2022, we would like to be on that run rate. So for 23, the goal is to be more than 40% blended gross margins. And beyond that, it's all a matter of volume. It's a matter of improving, let's say, the way we manufacture, cutting costs, and increasing gross margins. But in the shorter term, 30 to 35% in 2022 and more than 40 in 2023.
Okay. We're almost at the end here. Talk about, we've talked about 2022 quite a bit here, and some of the expectations, the guidance, some of the milestones. But to sort of summarize, what should investors be paying attention to ensure that you are hitting on the guidance and the goals and the expectations that you put out for 2022? And if we all sat here 12 months from now and looked back and said, okay, what are some of the biggest risks to achieving some of those goals?
Yeah, first of all, for 2022, we set some what I think is ambitious targets. We guided to $50 to $80 million in revenues, and based on the order book we have right now, we feel very confident that we can deliver on that. We also guided to being profitable, and I think we will be profitable as well in 2022. And everything we see right now tells us that the guidance we provided is a nice increase from where we are in 2021, but with the backlog we have and heading into 2022, it looks very realistic. Obviously, we are now guiding to increasing revenues 3x in 2022, and there's always a certain, you asked about the risks, and when you ramp the company in that way, it's never without hiccups. And our job here is to ensure that we execute well on the ramp. We think we will. We have made significant investments throughout COVID in new management, in more management, in new manufacturing equipment. And we think we are ready for the ramp. We experienced something very similar in 2019 when we tripled our revenues. We turned the company profitable. So we think, based on the experience we gained back then, we think it will be an easier job this time. But obviously, it's never easy to triple revenues. A little bit longer term, when we said 12 months from now, well, I'm convinced 12 months from now we have executed on our targets for 2022, and 2023 is setting up to be an even more exciting year. First of all, with basis in let's say the improvement in our business in 2022, we think we can continue that momentum going into 2023 and continue to build revenues in oil and gas, in membrane sales, in applications outside of marine and oil and gas, and of course also marine, where we still see very big opportunities. And then what happens in 2023 is also that the factory in China comes online, or really comes online, and that will be very interesting to see how that ramps. Again, we are building a $225 million capacity in China for a $26 billion opportunity. So I'm excited, first of all, to see the execution in 2022, but even more excited in 2023 to see the factory in China come online, to continue the momentum we are now building in several industries, and it will be exciting where we can take it beyond next year.
Fantastic. Well, look, we'll leave it there. We're at our time. Sune, greatly appreciate it as always. Again, anyone out there, if you'd like to arrange a meeting, please send me an email, Blum, BLUM at lythampartners.com, and I will look to coordinate. We hope you all enjoy the conference. Again, Sune, thank you very much.
My pleasure. Thanks, Robert.